Namaskar, this is Akhilesh Bhargav. Welcome to Tit-Bits on Business and Finance with me. It was sometime in January 2009 that Satyam lost its reputation. It was found to be involved in a giant corporate fraud of over 7,800 crores. And while Satyam lost its reputation, so did its auditors, PricewaterhouseCoopers, PwC as it is popularly called, because it was PwC which had certified and attested those bogus financial statements of Satyam in which that fraud was committed and perpetrated. It was a most serious offense. All agencies got into motion. The signing partners of PwC were arrested, put in jail. They were debarred from CA practice for life by the Institute of Chartered Accountants of India. The accounting regulator of America levied a fine of $7.5 million on Satyam because Satyam's shares were listed on the New York Stock Exchange. And SEBI banned PwC from undertaking any audit of a listed company by an order passed last year. Of course, that order got reversed by the Securities Appellate Tribunal a few days ago, holding that Satyam was certainly guilty of being negligent but not fraudulent in the matter. That was defeat of justice and technicalities, and it provides no solace to all those thousands of shareholders of Satyam who lost thousands of crores in this giant scam. Before we go ahead, we need to know what is PwC. PwC happens to be the second largest audit and accounting firm in the world, a member of the famous Big Four. It is headquartered at London. Its global revenues last year were $41.2 billion. It has its offices in 180 countries with over 2.5 lakh employees worldwide. Incidentally, it is known to have expertise in auditing, accounting, financial matters, management consulting, taxation matters, and in India, certainly matters related to FEMA and foreign exchange. And PwC worldwide faces numerous charges of professional negligence and misconduct, and India has been no exception to it. In the wake of Satyam, in the wake of the role of PwC in the collapse of the Global Trust Bank, it was in danger of losing its market share in India, a very lucrative market that no giant accounting firm can afford to lose. That is when its foreign parent started investing huge monies in India, completely contrary to India's rules, regulations, and guidelines. Thus, in 2009-10, PwC bought an accounting firm, an audit firm based out of Mumbai called Dalal & Shah. And for that, it paid 41.2 crores. Now, this investment or this acquisition of an audit firm by PwC overseas was contrary to India's guidelines related to FDI, related to FEMA, related to Institute of Chartered Accountants of India. And despite that, with PwC being an expert on FEMA itself, it decided to violate the laws of India. PwC overseas knew that this investment or this acquisition of Dalal & Shah was illegal. So what did it do? PwC overseas gave a loan of 41.2 crores to the local partners of PwC India. That money came from abroad. It was an investment, but they sent it by way of an interest-free loan, not refundable, to the partners of PwC India, and they bought Dalal & Shah. In doing this, they violated the FDI laws because FDI laws did not permit such an investment. In doing this, they violated FEMA because what was an investment was brought in by way of an unsecured, interest-free, non-refundable loan. And they violated the regulations of the Institute of Chartered Accountants of India because the Institute's regulations do not permit a foreign firm from buying and getting into audit practice in the Indian territory. And most important, they also violated the Binami law because the Indian partners of PwC actually bought Dalal & Shah on behalf of PwC worldwide. It was a Netherlands company of PwC which invested and sent this money from overseas into India. But this was not the end of the investment of PwC overseas into the Indian territory. Between 2009 and 2013, as per the findings of CBDT, PwC overseas sent a sum of 477 crores to PwC India in the garb of grants. Actually, this was also an investment. It was an investment by PwC overseas into business development and professional capacity build-up in India. It was an investment, but they initially called it reimbursement of expenses. PwC India then called it support charges received from abroad. And finally, they gave it the garb of being called as grants, non-refundable grants. This was again a violation of FEMA, FDI, regulation of the Institute of Chartered Accountants of India, and the Income Tax Act of India. These were the amounts that were brought in by way of investment into India by PwC overseas. Now, these monies did not come through some hawala route or through some non-banking route. These monies came into the official bank accounts of PwC India and its partners. And the receiving banks should have got suspicious of it and asked questions. The receiving banks kept quiet. This matter surfaced somewhere in 2013-14 itself, but all the agencies involved seemed to go slow on the investigation against PwC. The ED's investigation was slow. The action of the Institute of Chartered Accountants was slow. The Income Tax Department was slow in taking action against PwC under the Benami Act, and matters were going at a snail pace, showing the kind of clout that PwC has as an organization. But then, one NGO took it by way of a PIL to the Supreme Court. The matter reached the Supreme Court by way of PIL as to why, despite such a blatant violation of Indian laws by PwC, why was no action being taken against it? And the Supreme Court passed a scathing order in February 2018. The Supreme Court said that it was prima facie very clear that PwC had violated numerous laws of India. And it said that despite this clear finding and very prima facie violation by PwC, it was appalled that ED had not even completed its investigation in the matter despite investigating it for a period of 5 years. The Supreme Court was also critical of the Institute of Chartered Accountants of India, which it said had failed to detect this huge violation by PwC in as much as that such huge amounts were received from abroad for the purpose of investing in the audit profession, and the institute took no action. It was also critical of the Income Tax Department for not having taken any action under the Benami Act, because PwC Worldwide actually bought Dalal & Shah, an Indian audit firm, by giving money to the partners of PwC and thus holding Dalal & Shah indirectly in this manner. Supreme Court, as I said, was scathing, and they asked all these agencies, all these authorities to conclude that this matter, their investigation and action in a time-bound manner. It asked the ED, it directed the ED to complete its investigation within a matter of 3 months. It also asked the Institute of Chartered Accountants of India to complete its proceedings in 3 months. And it asked the entire matter to be taken to its logical conclusion, holding that there was a prima facie case of serious violation of these laws, which is FEMA, FDI, regulation of the Institute of Chartered Accountants of India, Benami Act, and the Companies Act by PwC India. Newspaper reports say that ED has concluded its investigation and has issued a show cause notice to PwC India for having brought in huge amounts of money, hundreds of crores, by way of investment into India, contrary to the regulations and laws of India, thus having violated the FDI laws and the FEMA laws. ED is likely, or it can levy a penalty of 3 times this amount on PwC, apart from a jail sentence which is likely under the laws. So, ED has now completed its investigation. A show cause notice has been finally issued after such a long delay of years together. The larger issue, according to us, is the seriousness of the violation by PwC. PwC is known for its expertise on many matters, including foreign exchange and FEMA matters. It obviously violated the law so knowingly that what was brought in as investment by it was actually shown as grants. This was a conscious violation by a most reputed organization that it claims itself to be. And if you compare this violation with the case of Aircel Maxis, wherein Chidambaram is in Tihar jail at the moment, what you will realize is that while in the case of Aircel Maxis, the case was reported and some kind of an approval was taken from the government, even though that approval was wrong, but the case was reported. In this case, PwC concealed the transaction in such a manner that the case was never intended to be reported, and the amount involved is over 500 crores. And because of this seriousness of the matter, that it was a deliberate offense committed by PwC, it deliberately ensured that the matter was never reported. The likes of banks colluded with it in as much as they did not report this violation of FEMA by PwC. Because of these charges, because of this background facts, we would certainly say that it deserves the most stringent punishment. This is not an ordinary violation of multiple laws by PwC, which is known to be an expert on all those laws, and it provides consultancy on all those laws to all and sundry in India. This is Akhilesh Bhargav signing off till we meet again. Namaskar.